I mean, rates matter a lot, and maybe even more than in residential, because in residential, you still have a lot of people who are buying because they they need to buy a house, they want to buy a house. There's still plenty of people who are willing to fall in love with a house, overpay for a house, pay anything to get it. All that sort of stuff still happens. In commercial real estate, there are very few people who need to buy a property.
Well, pending home sales was a significant disappointment. Pending home sales was expected to only be down 1%, actually came in down negative 7.7%. So a significant miss in monthly activity. Earlier this month, we saw new home sales also disappoint. What I want to do in this conversation is I want to have a conversation about residential real estate and commercial real estate. Talk about what may be the same, what may be different. In order to have this conversation, we have to have somebody that plays in that space and is very knowledgeable. Of course, for us, that is Jonathan Twomley. How you doing, sir?
I'm doing great, Michael. How are you today?
Oh, man, I'm doing very, very well. I couldn't think of anybody better in my roster of millionaires
Mhm.
to have this conversation than with you. So let's get it started. Right. I obviously am very much a residential real estate investor. I look at the market nearly every day and think something we are seeing in residential real estate that has become painfully obvious is that any rates above 7 significantly reduces demand. Now, new home builders were able to kind of meet demand by buying down rates. That now seems to be less true. But in pending home sales, we now have had rates above 6.7% for a year, according to Nikki Leaks from the Wall Street Journal. But now we have pending home sales down 7.7% this month. So one of the things we know about residential is rates matter. What does it mean for commercial real estate?
I mean, rates matter a lot, and maybe even more than in residential, because in residential, you still have a lot of people who are buying because they they need to buy a house, they want to buy a house. There's still plenty of people who are willing to fall in love with a house, overpay for a house, pay anything to get it. All that sort of stuff still happens. In commercial real estate, there are very few people who need to buy a property, right? I mean, maybe they have a 1031 they have to do. Maybe they have money that they have to place, but even there, they may often feel, okay, we're going to just hoard cash until there's a better opportunity to buy. So nobody has to buy. And on the sales side, that's what where things are really being affected. Because interest rates have gone up, what buyers are willing to pay is a lot less because they have to make a return, and the return has to be in excess of what they're paying for their money, right? The rent they're paying on the money. So uh, they're willing to pay less. Sellers still want their old prices or maybe locked into debt that there's properties that are the debt is worth more than the property now, and it's hard to get out of those deals without a lender agreeing to let you do a short sale. We're not seeing a lot of those yet. I think they're going to come, but as a result, very similar data just came out in the multifamily market. We're now back down to the volume of sales that happened at when COVID first hit, when the market just
Wow.
basically collapsed because nobody knew what was going on. So um, the market is back down to, a 4-year low in terms of volume. And that was a very low given what was going
Mhm.
on in that unique circumstance of the beginning of COVID. So uh, interest rates matter for commercial too.
Yeah, and I think you're right. Having played in both sides, I think interest rates matter, frankly, a lot more in commercial than residential. But hey, if you're following residential and you're watching rates, some of that absolutely applies to commercial. Here's another thing that I think about residential. Again, given the current environment, we have seen a significant increase, and I suspect almost a record number of cash buyers. We are seeing cash buyers in some months, some quarters in excess of 30%. I'm gonna guess that doesn't normally happen. You're not gonna see 1 in 3 or even 1 in 4 commercial transactions done with cash, will you?
No, no, just because of the again, the size of the transactions, there aren't that many people with that much cash. I mean, even big funds don't generally buy for cash, even if they do low leverage. They still need leverage to make the returns that they want to make. And that's really the fundamental issue. They just can't generate the returns that they want without using leverage. So
Yeah.
you don't really see a lot of cash. Every once in
Yeah.
a while you do, but generally speaking, most of these deals are levered in some way.
I think there's a subtle thing in there that I think most people would miss, and I didn't even think about this until you brought it up. In residential real estate, it is, I'm going to guess, 95% plus of the residential transaction is an individual or a couple purchasing. Now, we have seen over the last couple of years more and more parties, right? Friends buy properties together, but still that is a very small number. In commercial real estate, it is often, and I would argue, a business model to collect capital from lots of people and then put said money to work. Hence, you need to get a return, right? And you need to get a return and a spread so that the operator makes theirs. So a lot more parties involved in a single commercial transaction than a residential transaction.
Yeah,
I would
and
say.
even if it's not a syndication, like the syndication model, which is what I used, you have that directly where you literally pool people together and you buy a property. But even if it's an insurance company or if it's a private equity fund, they're all pooling money. Ultimately, they're pooling money, even though they stand in that transaction as a single entity with a big checkbook. They still, as you say, have to produce a return to whoever it is that provided the money in the first place. Or in the case of insurance companies, they need to provide a return because that's how they're generating enough money to pay out claims,
Claims.
right?
Yep. Yep.
So yeah, ultimately in commercial real estate, there's somebody at the somewhere in the transaction that needs to get paid back their money, and that with a return on it, and that is what kind of acts as a constraint on commercial real estate.
I like it. I like it. The other thing that is going to become painfully obvious as we get through this period, which may last a couple of years, is the residential real estate market has perhaps one of the greatest assets, and that is the 30-year fixed rate mortgage. Not only that, but it doesn't have covenants, right? It doesn't say, hey, if your house goes down 20%, you have to do a cash in refi. There are none of those, at least none that I'm aware of in the residential game. Commercial is almost always short term, and a lot of them have kind of these excess covenants that say, hey, you know, you got a problem early, fix it. Is that fair?
Well, yeah, and not just that. I mean, you know, you get covenants with your commercial debt that says, you know, paying your loan every month on time isn't enough. If you're not generating at least
Exactly.
1.25x in revenue over your payment, then you're in breach of a covenant, and that won't lead to foreclosure, but it may lead to other consequences. You know, there's all kinds of stuff that comes with commercial debt. You know, you could be in breach of a covenant if you don't send in your personal financial statements every year,
Yeah.
or even if you're paying your debt. So paying your debt is not enough in
Right.
commercial real estate to be in compliance with the loan. So whereas
Yeah.
on the residential side, they don't really care as long as you're paying your mortgage.
Yep. Absolutely. Absolutely. The other thing that I think a lot of folks don't realize, and this is just my opinion, so feel free to disagree, because residential real estate is kind of comp based, like, other similar properties. Commercial real estate, certainly in an environment where rates have gone up, 300 basis points in a very small window, you're going to see price degradation a lot quicker in commercial real estate than you would in residential real estate. Is that fair to say, or am I off base?
Yeah, no, absolutely. What we're seeing, you can, and the thing about it is with commercial real estate, you can just do the math and figure it out,
It's just
right?
math. Yeah,
Yeah,
exactly.
like unlike with residential, there's all these other factors involved to try to figure out what it's worth. And like you said, comps are the way that you do it because it's hard to figure out another basis on which to do it. But with commercial real estate, as you and I have demonstrated on the show, it's you just
Just math.
you
Yeah.
just figure out your net operating income and then you just apply a cap rate to it. So if rates go up, you can just run your spreadsheet and show you like, well, how much can you afford to pay at this rate? And it's just math. So it's very
Yeah.
easy to predict. What's happening in the market right now though is that deal volume is so thin that there hasn't really been price discovery yet. No one really knows what the price of anything is yet because there's so few deals on the market. And when basically what's been happening is people put stuff on the market and either if they don't get the price they want, they pull it off the market. They don't sell.
Mhm.
And if it's really high quality property, they're getting bidding wars because there's just so little on the market, and
Yeah.
and people are willing to, I guess, you know, overpay for a high quality property when there's really nothing else available.
Yeah. I think probably the biggest chuckle I got yesterday was when a follower of our channel sent me a thing on Instagram. Folks, if you want to send me a direct message on Instagram, it's just one rental at a time. He sent me a Bigger Pockets article, and just the headline says, many commercial buildings around the country are being sold at 50 to 80% discounts. I chuckle because you and I told people this was coming. We
Yeah.
showed them the math. We took $100 million building and with very small tweaks, turned it into 48 million bucks. Folks, we warned you this was coming. We tried to stop you LPs from investing in these deals, and your money's gone. It's just
Yeah, I mean, listen, and those deals are the obviously office deals, right? So it's not, fortunately, it hasn't happened to the same extent. We have not seen any reports of properties in the multifamily space being sold, for a quarter of their
well,
last sale price.
we can't say that. I mean, there was that Houston portfolio that was it.
Right, but it didn't go for a quarter of the previous
Oh,
sale
it was
price.
down 40%, but yeah,
Yeah.
okay. It
Yeah,
wasn't
and we
80%.
don't really know what the end price of that was. I don't think it got
Mm,
bought in a private sale, and I'm not, so it's hard to really say what exactly
sure.
happened. There was definitely a discount happening, and it's definitely the case that, you know, properties bought at the peak of the market right now may not have any equity left. And the real issue is, does the debt that you have on the property allow you to just ride out the cycle and come out fine on the other side? Or are you facing either, an issue with, variable rates that have crushed you, or you might have a good rate, but a maturity problem where your debt's coming due and you have to refinance in this bad environment. And this is something that, I talked about so much back in 2019, 2020, like telling people that the risk that they were running by doing short-term debt was, buying at the top of the market, was that you ran into maturity risk, right? You might be refinancing in a bad situation. So you want to have long-term debt, and people would complain like, oh, well, long-term debt, there's all these prepayment penalties. And well, yeah, that's true. But, like, that's the price you pay to be able to pick the time when you sell and not be forced to
Right.
sell.
Yeah, absolutely. The other thing that I think is interesting when you look at the two markets today, I think it was yesterday, it might have been, I think it was Monday or Tuesday, actually. Case Schiller came out and said residential housing was at a record. When I look at commercial real estate, even if we just go commercial real estate multifamily, I believe, and again, correct me if I'm wrong, that currently from the peak, multifamily is down about 28%.
Yeah, depends on who you follow, but yeah, somewhere
In
between 20 and 30 is generally the consensus.
where it is today. And I think that's
Yeah.
interesting. Going back to something you mentioned earlier, we haven't seen price discovery. In my opinion, we have seen assets trade that are generally speaking class A. We have yet to see class B and C trade where I think most of the pain is coming because again, in my market, I have C class buildings. In my market, C class buildings generally trade between 7.5 and an 8.5 cap. I sold my last apartment at a 5 cap. They went as low as a 4.5 cap. Right? I sold it at a 5.5 cap. Went as low as 4.5. That regression to the mean is coming,
Yeah.
but we're not seeing those deals trade. So I don't think it's out of the world to think that there could be a 50% discount on those assets coming
Yeah.
just with math.
From the peak to the trough. Yes. I mean,
Yes.
if those deals were trading at 4 caps, that that could be where what people are looking at. If they, the reason that C class deals were trading at such low cap rates is because people were overpaying because they thought they were going to do a value add,
Yeah,
and
that was the sexy thing. Yep.
right, and if they pulled it off, right, if they did get their value add done, and they did increase the NOI of the property substantially, then they ought to be able to ride this out. The problem is that so many people so grossly overpaid for the property that once they got into it, they realized that actually executing the value add didn't make sense. What made sense was to do a few apartments to call it a proven value add and sell it to the next guy, right? So, and if you were one of those people where you were really not doing the value add, you were just kind of pretending to do the value add, and your whole model was like, let's just keep on rolling this log. Those are the people who are getting caught short because they haven't added, maybe they've added the NOI with respect to 20% of the units, but they've only done it with 20% of the units, right? So they haven't increased it across 100% of the units, which is what they really need to do to save them. So but they just never anticipated having to do it because their model was, we're going to sell it in 2 years,
Right.
So
Yeah. One of the things that I actually think is pretty similar, in my opinion, between residential and commercial is what's being built, what's coming online. At least in residential, it does seem to be kind of the luxury, kind of the move up quality stuff. It's the stuff that pencils. We haven't seen really any focus until very recently. I think Lennar's taken a shot at it, but we haven't really seen kind of new affordable product. Now I hear a lot about the Sun Belt. I'm going to guess a lot of that stuff coming online is Class A, but maybe I'm wrong.
I mean, it's pretty much always been the case that new apartments are Class A, right?
Okay.
It has never really made sense to build Class B, right? But the whole property sort of life cycle is that as new Class A, product is added, then the people who want that product move out because there's always a certain segment of the market that wants the best place. They want to be in the nicest apartment. And so they move out of the Class B into the Class A. And then you kind of have this. So the properties, it's called filtering, right? So the properties filter down. And so we're seeing this in real time in, in the Sun Belt where a ton of Class A got built. And, the common wisdom, at least on social media, was always, oh, well, Class B and C are safer because they're cheaper. It's a very simplistic way of looking at things. If there's a bad economy, people will go to Class B and Class C. What's actually happening is the opposite, right? Class A is so overbuilt that they're offering massive concessions and they're pulling all the best tenants from Class B. And the Class B is then turning around and having to do the same, pulling all the top Class C tenants. So B and C are really sucking wind. I mean, Class A is sucking wind too, but everyone thought that B and C were somehow insulated from this because of the rent differential between A and B and C. Turned out that, well, with concessions, you can make that rent differential go away, right?
Yeah,
So,
exactly.
and so that we're seeing a lot of that happening in the Sun Belt at the moment. So that oversupply is not just affecting the Class A properties, it's affecting all properties.
Yeah. Something that I wrote about in my book, One Rental at a Time, that I never really asked someone like you who has experience on predominantly on the other side. So I'd love to hear if I'm right or off base. Is I think residential real estate cycle and the commercial real estate cycle are different. I think a lot of people conflate them. A lot of people think they're exactly the same, and I don't believe that's true. I believe residential could have a completely different cycle than commercial. But again, what do you think? Was I off base when I wrote that?
No, well, I think they can coincide, but they don't have to coincide, right? So I
Right.
think now they're coinciding because of interest rates, because interest rates affect both of them. But you can definitely, like in a more traditional environment, historically, where we didn't have these crazy super low interest rates and this huge amount of retail investor money pouring into the market, to make the market soar the way it did, the prices would be relatively stable, basically growing according to NOI growth, right? They weren't looking at, there was always some cap rate compression, decompression, but more or less, you were looking at growing the value of the asset by growing the NOI over time, which essentially like reflected inflation, right? But when rents got better, you'd have more building, and when rents declined, you'd have less building. And that was, so the market cycle was essentially the construction cycle. in
Right.
real estate, right? So when you had population growth and rents went up, then you'd have a boom of construction, and then that would cause rents to decline, and then the construction stops. So that's what followed the cycle, and that could be completely independent of what was going on in the economy generally, which is going to affect the housing market more, right? So you can
Mhm.
definitely have these markets out of phase. But in
Yeah.
the last two cycles, the great financial crisis and what's happening right now, both of those were interest rate driven.
Mhm.
So the collapses, right? So they're in sync because they had the same underlying cause. It wasn't
Let's poke at that, right? As we said earlier, single family homes, at least as last reported, as at a record high, and commercial real estate multifamily is down, let's call it 25%. I would say that's out of phase.
well, I guess in that sense, I was thinking about, you could also look at it in terms of volume, right?
Yeah,
So
transactions,
yeah,
absolutely correct. Yeah, yeah,
yeah,
transactions.
yeah.
Yeah, transactions. And again, that's something that I called very early, was right. We've had a depression level event in residential real estate transactions. We're down 40 to 50%, in some markets 60%. That's a depression
Oh
level.
yeah. I mean, the same thing in
Depression.
commercial, right? And so I read someplace, I wish I could find this stat, and maybe you seem to always have all the stats, but
Mm.
I read someplace that something like 50% of all like mortgage brokers and commercial real estate brokers have left the business because
Yeah,
there's
I,
just,
I talked to I talked to three different
yeah,
brokers. They both have brought that stat up. Between 50 and 60% have already left the
yeah,
business.
yeah.
Correct. Yeah.
Because they have no business. They have nothing to do.
Nothing to do.
So,
Exactly. Oh,
yeah.
it's very expensive. Well, Jonathan, I appreciate having this conversation with you. I love the fact that you bring an entirely new perspective to the market. Where should people reach out? Where should they follow you? Where should they say hi?
Well, come to LinkedIn, follow me there. I'm very active on LinkedIn, and we can actually have conversation there. And like you offered, that people can DM you on directly on Instagram, you can DM me directly on LinkedIn. However, if you'd like to get on my email list, the quickest way to do that is go to apartmentinvestorsclub.com and grab the free download that we have there.
You're awesome, Jonathan. Thank you for coming back each week. Next week, folks, we're going to look at market psychology. That's a presentation I've been looking forward to. So it's a little tease for next Thursday. Thanks, Jonathan.
All right. See you, Michael.